Every empire in history has searched for the same thing, a way to control others without constant war. Armies are expensive, occupations are unstable, violence creates resistance. The most successful empires eventually discover a quieter method, one that feels invisible to those trapped inside it. In the modern world, that method is not the tank, the missile, or the aircraft carrier. It is money. More specifically, it is the dollar. Today, the US dollar sits at the center of the global economy. Oil is priced in it. Trade is settled in it. Debt is denominated in it. Central banks store it as a reserve. This arrangement feels natural, almost inevitable, as if the dollar simply earned its place through stability and trust. But this perception hides a deeper truth. The dollar did not become dominant by accident. It became dominant through design. And once that dominance was secured, it became something far more powerful than a currency. It became a weapon. To understand how this happened, we have to go back to a world that was broken. In 1945, the Second World War ended, and with it, the old global order collapsed. Europe was in ruins. Britain was bankrupt. Germany and Japan were destroyed. Entire cities were reduced to rubble. The global financial system that had existed before the war based largely on gold, and the British pound was no longer functional. Someone had to rebuild the system. And only one country was in a position to do so. The United States emerged from the war uniquely powerful. Its cities were untouched. Its factories were running at full capacity. It held the majority of the world's gold reserves. While other nations were counting their dead, America was producing steel, food, machinery, and weapons at an industrial scale never seen before. This imbalance gave the US enormous leverage, and it used that leverage to reshape the world economy and its image. In 1944, before the war had even ended, representatives from 44 countries gathered in a quiet town in New Hampshire called Bretton Woods. Officially, the goal was stability, to prevent the kind of economic chaos that had fueled depression, nationalism, and war in the 1930s. Unofficially, this meeting marked the birth of a new financial hierarchy. The agreement they reached placed the dollar at the center of the global system. Under Bretton Woods, the dollar was pegged to gold, and every other major currency was pegged to the dollar. In theory, this made the dollar as good as gold. In practice, it made the world dependent on US monetary policy. Countries could no longer operate freely. To trade internationally, they needed dollars. To stabilize their currencies, they needed dollars. To rebuild their economies, they needed dollars. At first, this system looked benign, even generous. The United States provided loans, aid, and access to its markets. The Marshall Plan flooded Europe with dollars to rebuild infrastructure and industry. But this generosity came with a condition that was never written down but always understood. The global economy would run through the American financial system. This was the crucial shift. For the first time in history, a single nation's currency became the backbone of global trade. Gold still existed, but it was no longer moving. Dollars were. And wherever dollars moved, American banks, American laws, and American influence followed. Over time, the gold backing became less important than the system itself. Countries held dollars not because they intended to redeem them for gold, but because they needed them to function. The dollar stopped being a claim on metal and became a claim on access to trade routes, markets, credit, and growth. This is when the currency quietly crossed a line. It stopped being neutral. By placing the dollar at the center of global finance, the United States gained a power no empire before it had ever possessed. The ability to influence other nations. Economies from the inside. Inflation, interest rates, liquidity, all of these could now be affected by decisions made in Washington and New York. A country could have a strong military, a disciplined population, and abundant resources, yet still find itself constrained if it was cut off from dollar flows. This power was not immediately used as a weapon. In the early years, it functioned more like gravity, subtle, constant, unavoidable. But gravity can be weaponized if you control the environment. And as the decades passed, the US learned that controlling money was far more effective than controlling territory. By the end of the 20th century, the dollar had become something unprecedented, a global choke point. To touch the world economy was to touch the dollar, and to touch the dollar was to fall under American jurisdiction. This was the foundation upon which everything else would be built. The world believed it was using the dollar. In reality, the dollar was shaping the world. For the first 25 years after Bretton Woods, the system appeared stable. Currencies were fixed. Trade expanded. Growth returned. On the surface, the dollar seemed disciplined, anchored by gold, restrained by international agreement. But beneath that calm, pressure was building. The system only worked as long as the United States could maintain the illusion that every dollar in circulation could be exchanged for gold. And slowly, that illusion began to crack. The problem was simple and structural. The world needed dollars to grow, but creating more dollars weakened the gold backing. This contradiction became known as the Triffin dilemma. If the US printed too few dollars, global trade would choke. If it printed too many, confidence in the dollar's convertibility would collapse. For a time, America tried to balance both. Eventually, it chose dominance over discipline. By the late 1960s, the costs of American power were exploding. The Vietnam War drained resources. Social programs expanded at home. Military bases spread across the globe. Dollars poured out of the US to pay for troops, weapons, and imports. Foreign governments, particularly in Europe, began to notice that the number of dollars in circulation far exceeded the gold held at Fort Knox. France was the first to openly challenge the system. Under President Charles de Gaulle, the French government accused the United States of abusing its exorbitant privilege. They began converting dollars into gold and shipping it back across the Atlantic. Other nations followed quietly. Gold reserves in the US began to shrink. Confidence eroded. The system was reaching a breaking point. On August 15, 1971, President Richard Nixon went on television and made an announcement that would redefine global finance. Without consulting allies, without international negotiation, the United States suspended the dollar's convertibility into gold. The gold window was closed. Just like that, the anchor was cut. Officially, this was described as a temporary measure. In reality, it was permanent. The world had just entered an entirely new monetary era. The dollar was no longer backed by anything tangible. It was backed by trust, by power, and by necessity. This moment changed everything. For the first time in history, the global economy ran on pure fiat money, issued by a single state. The United States could now create dollars without any material constraint. There was no gold limit, no external discipline. As long as the world needed dollars, the US could supply them and shape the consequences. But a question immediately arose. Why would other countries accept this? Why continue using a currency no longer tied to gold? The answer came through geopolitics. In the early 1970s, the US struck a quiet but transformative deal with Saudi Arabia, the largest oil producer in the world. In exchange for military protection and political support, Saudi Arabia agreed to price its oil exclusively in US dollars. Other OPEC nations followed. Oil, the lifeblood of industrial civilization, would now be bought and sold in dollars. This created the petrodollar system. Every country that needed energy now needed dollars. To get dollars, they had to export goods, borrow from dollar markets, or align with the US-led financial system. The dollar was no longer just the medium of trade. It became the entry ticket to modern life. Freed from gold, backed by oil, and enforced by American military and financial power, the dollar entered a new phase. It was no longer constrained by scarcity. It was constrained only by confidence. And confidence, the US discovered, could be managed. This is when the dollar began to evolve from a foundation into a lever. By controlling liquidity, interest rates, and access to dollar clearing systems, the US gained unprecedented influence. Economic crises in Latin America, Asia, and Africa were no longer purely local events. They were shaped by decisions made by the Federal Reserve. Capital flowed in when rates were low and fled when rates rose, leaving devastation behind. Still, this power remained mostly indirect. The dollar shaped outcomes, but it had not yet been openly weaponized. That would come later. First, the system had to prove that there was no alternative. By the end of the 1970s, every major economy was locked into the dollar-based order. Trade, debt, commodities, and reserves all ran through it. Nations could complain, but they could not escape. Money had finally broken free from metal. And in doing so, it had become something far more dangerous. Once the dollar system was locked in, its true power began to reveal itself. At first, it looked like simple monetary dominance. But over time, policymakers in Washington realized something far more important. If the world needed dollars, then controlling access to dollars meant controlling behavior. Money was no longer just a tool of trade. It could be used to punish, isolate, and coerce, without firing a single shot. This realization matured during the late Cold War. Traditional sanctions, trade bans, embargoes, diplomatic pressure were blunt instruments. They were slow, leaky, and often ineffective. But the dollar system offered something new: precision. Nearly all international trade flowed through dollar-denominated banks. Even when two foreign countries traded with each other, the transaction usually cleared through U.S. correspondent banks in New York. That meant the United States didn't need to physically block ships or seize cargo. It could simply deny access to the financial plumbing that made trade possible. The first experiments were subtle. Countries that aligned with U.S. interests found it easier to borrow. Those that didn't face higher interest rates, tighter credit, and sudden capital flight. The International Monetary Fund and World Bank, both dollar-centric institutions, became gatekeepers. Assistance came with conditions: privatization, austerity, political reform. Compliance was rewarded, resistance was punished. Then came the turning point. In the 1980s, the U.S. Federal Reserve sharply raised interest rates to combat domestic inflation. This decision, made for internal reasons, detonated economies across the developing world. Dollar-denominated debt suddenly became unpayable. Latin America entered a lost decade. Africa spiraled into crisis. Entire nations collapsed under obligations they could no longer service. This was not accidental damage. It was structural power. The dollar system allowed the U.S. to export its monetary policy globally while insulating itself from the consequences. When dollars became scarce, the world suffered first. When dollars flooded markets, asset bubbles formed elsewhere. Either way, the center held. By the 1990s, after the Soviet Union collapsed, the dollar faced no rival. The U.S. now controlled the world's reserve currency, the world's payment rails, and the world's financial institutions. For the first time in history, a single state sat at the heart of global money. That is when financial warfare became explicit. Instead of sanctioning goods, the U.S. began sanctioning banks. Instead of banning trade, it banned access to SWIFT, correspondent accounts, and dollar clearing. This was devastating. A country could have resources, factories, and buyers, but without dollars, nothing moved. Companies couldn't pay suppliers. Governments couldn't service debt. Imports vanished overnight. And because the dollar touched everything, compliance was global. European banks, Asian corporations, and Middle Eastern traders all followed U.S. rules. Not because they wanted to, but because exclusion from the dollar system meant financial death. This created a chilling effect. Even when sanctions were limited, the fear of being cut off caused overcompliance. Firms withdrew, insurance disappeared, shipping halted. The targeted economies suffocated. What made this weapon so effective was its invisibility. There were no explosions, no invasion footage. Nobody counts on the evening news. Collapse happened quietly through empty shelves, currency crashes, inflation, and unemployment. Governments fell not to armies, but to balance sheets. By now, the dollar was no longer neutral. It had become an enforcement mechanism. And yet this power came with a hidden cost. Every time the dollar was weaponized, it reminded the world of its vulnerability. Allies began to notice that what could be used against enemies could also be used against them. Trust slowly eroded. Conversations began first quietly, then openly about alternatives. But breaking free was not simple. The system was too entrenched. Trade, reserves, debt, and finance were all entangled. Escaping the dollar was like trying to remove gravity from the economy. Still, cracks were forming. As financial warfare intensified, nations started seeking insulation. Gold reserves, local currency swaps, parallel payment systems. None were strong enough yet. But the instinct was there. The dollar had reached its most dangerous form, not because it was powerful, but because it could be turned off. And once the world realizes that money can be used as a switch, the question is no longer whether it will be abused, but how long others will tolerate it. The age of invisible economic warfare had begun. The more the dollar was used as a weapon, the more it exposed the fragility of the system it dominated. What once felt like stability began to resemble dependency. And dependency, when paired with coercion, inevitably breeds resistance. By the early 2000s, the backlash had begun, not as open rebellion but as quiet preparation. The problem every country faced was the same. The dollar system was not optional. Trade was priced in dollars. Debt was issued in dollars. Reserves were held in dollars. Even domestic banks needed access to dollar liquidity to survive. Opting out meant isolation. Staying in meant vulnerability. So nations didn't try to overthrow the system. They tried to insulate themselves from it. The first line of defense was reserves. Central banks began accumulating gold at a pace not seen since the Cold War. Gold had no counterparty risk. It couldn't be frozen by a foreign court. It didn't depend on a payment network. It just existed. Countries that had once dismissed gold as obsolete quietly began buying it again. At the same time, governments started reducing their exposure to U.S. Treasury debt. Not abandoning it because there was no alternative large enough, but diversifying away from total dependence. Even small shifts sent a message. Trust was no longer absolute. The next move was infrastructure. For decades, SWIFT had functioned as the nervous system of global finance. Officially neutral, it was in practice aligned with U.S. and European regulatory power. When banks were disconnected from SWIFT, they didn't just lose messaging. They lost legitimacy, transactions stopped, insurance vanished, trade froze. Seeing this, countries began building parallel systems. Russia developed SPFS. China built CIPS. These systems were smaller, slower, and less efficient, but that wasn't the point. Their purpose was survival under pressure. Currency swap agreements followed. Instead of settling trade through dollars, countries began settling directly with each other. Yuan for rubles. Rupees for dirhams. These deals were limited and often symbolic, but they represented something new. The willingness to accept inconvenience in exchange for autonomy. Then came the psychological break. The moment that changed everything was not economic, it was political. When major powers demonstrated that reserves could be frozen, assets confiscated, and central banks locked out of their own money, the illusion of neutrality shattered. What had always been implicit became undeniable. Reserves were no longer safe. They were permission-based. This realization traveled fast. Countries that had never been sanctioned began asking uncomfortable questions. What if we are next? What if our politics shift? What if our interests diverge? Trust, once cracked, does not heal easily. But escaping the dollar was harder than questioning it. Every alternative came with costs. The euro lacked unified fiscal backing. The yuan was controlled and not fully convertible. Crypto was volatile and politically radioactive. Regional currencies lacked scale. The system persisted not because it was loved, but because it was unavoidable. And yet, something fundamental had changed. The dollar's dominance now carried a contradiction. The more it was weaponized, the more it motivated others to weaken it. But the more others tried to weaken it, the more the U.S. relied on weaponization to maintain control. This feedback loop created instability. Financial markets thrive on predictability. Weaponized money introduces uncertainty. Capital becomes cautious. Trade fragments. Alliances strain. The system grows brittle. Even allies began quietly hedging. European leaders spoke openly about strategic autonomy. Asian economies discussed regional settlement. Middle Eastern producers explored non-dollar contracts. None of these moves dethroned the dollar, but they signaled something unprecedented. A loss of unquestioned legitimacy. History shows that monetary systems don't collapse overnight. They erode slowly. Then suddenly, the dollar was still dominant. But it was no longer invisible. And once power is visible, it invites challenge. The backlash was no longer theoretical. It was structural. And it was accelerating. The most dangerous weapon in the world was beginning to generate enemies. Not because it was used recklessly, but because its existence demanded obedience. And obedience eventually breeds defiance. Every empire eventually faces the same dilemma. The tools that create dominance are rarely the tools that preserve it. The dollar, once designed to stabilize the world, evolved into the most effective instrument of economic control ever created. But by becoming the world's most dangerous weapon, it also became its most fragile. At the heart of the system lies a paradox. For the dollar to function, the world must trust it. For the United States to maintain control, it must occasionally threaten that trust. Each time the dollar is weaponized, it succeeds in the short term and weakens itself in the long term. This is not a moral argument. It is structural. The dollar dominates because it sits at the center of trade, debt, and reserves. That position depends on scale, liquidity, and confidence. No rival currency currently matches all three, but confidence is not binary. It erodes gradually. And erosion does not need a replacement to be dangerous, it only needs doubt. What makes the current moment unique is that alternatives no longer need to defeat the dollar. They only need to reduce exposure to it. A world that settles 80% of trade in dollars behaves very differently from one that settles 60%. Financial power is not lost all at once. It leaks, and that leak is already visible. Trade is fragmenting. Supply chains are being regionalized. Financial systems are becoming modular rather than universal. Countries are building redundancies, not revolutions. This is not de-dollarization as a headline event. It is de-dollarization as risk management. For the United States, this creates an uncomfortable future. The dollar's strength has allowed America to run deficits without consequence, to finance power without immediate sacrifice. But that privilege depends on external demand. If that demand weakens, even slightly, the costs return home. Weaponized money works best when it is rarely used. Overuse transforms it from deterrent to catalyst. There's also a deeper danger. Financial warfare blurs the line between peace and conflict. When economies are attacked without declaration, retaliation does not always come in kind. It comes asymmetrically through cyber operations, trade disruptions, political destabilization, or military escalation. Money that once prevented war can, paradoxically, accelerate it. History offers no example of a dominant monetary system surviving the moment it becomes openly coercive. The British pound declined not because Britain was defeated in battle, but because it could no longer sustain the system it had built. Confidence shifted, the center moved. The dollar is not immune to this logic. That does not mean collapse is imminent. Power rarely disappears. It redistributes. The dollar will remain central for years, perhaps decades, but its uncontested dominance belongs to the past. What replaces it is not a single currency, but a fractured order. Multiple settlement systems, competing standards, regional blocks. Higher friction, lower efficiency, more uncertainty. This is the cost of turning money into a weapon. The final irony is that the dollar's greatest achievement, binding the world into a single financial system, made it indispensable. And its greatest failure may be reminding the world that indispensability can be exploited. Once that lesson is learned, it is never forgotten. The world's most dangerous weapon was not built in a laboratory or a missile silo. It was built in ledgers, treaties, and banking systems. It reshaped empires without firing a shot. And now, quietly, it is reshaping the future of power itself. Not because it is weak, but because it is too strong.